All right, everybody. Good morning and welcome to week 14 TGIM. And this is your weekly Macro Monday call. So I'll be joined today by the very talented James Kim, who's off back from a very, very busy roadshow. And he will be covering the charts, obviously, today. It goes without saying that obviously everything we do and cover is solely views, opinions, not trading nor investment kind of recommendations. Moving on to just a quick review of basically what went down last week. These are some two links that we have from when I was on CNBC, basically talking about kind of Article 50, Sterling, London real estate. Actually gotten quite a lot of interest from clients, so it's something to definitely take some time on, maybe catch it on the replay to see if it's something that resonates with you positively and negatively. So I'll just start a little bit kind of backwards and just see where we ended. This was obviously from the closes on Friday. We had, again, fixed income kind of divergence, very much tighter on bunds. We're kind of closer to 40 basis points, a little bit over a week back, like 2 Fridays back. We did see the U.S. a little bit tighter. Funnily enough, JJBs continue to kind of be unchanged despite this kind of significant kind of pullback in that we've had in bunds. So that kind of bears watching. Very, very big week on the oil and energy kind of side. As you know, this was something that we were pushing very heavily last week, tactical kind of longs in WTI. We'll touch on that a little bit later. And of course, the equity grind continues completely unabated. The U.S. equity market seems to be the Teflon Dawn, as they say. And of course, volatility still nothing to be really kind of seen. So I think kind of last week, at least from my perspective, the things that kind of stood out were obviously Article 50 being triggered, no key moves or really anything from it as we kind of anticipated. But obviously now we have the formal kind of clock ticking there. There was a lot of Fed speak, which the market paid attention to, kind of ended up pushing the U.S. dollar up about 73 kind of basis points, which, definitely the risk was to the upside of the U.S. dollar because post kind of the Fed, a lot of people were liquidating USD longs. What was interesting was you even had people like Rosengreen actually talking about 4 hikes for 2017 in order to kind of curb the hot kind of economy. This is really interesting on this kind of focus that the Fed speak kind of got, given the fact that the next meetings are not until May 3rd and June 14th, quite a while away in these kind of markets. PMIs were mixed from a China reading perspective. The official was in line to grow in 51.8 versus 51.7 that was expected. The Taixin, which used to be called the HSBC China PMI, came in at 51.2, which was less than the 51.8 expected, as well as trending down from the 51.7 kind of previously. Probably most important from an economic kind of data point, and what ended up hosing my view on euro dollar longs was this kind of a combination of eurozone inflation. And I think the question is, are we seeing a temporary pullback, or are we actually seeing the highs in inflation? So we had some missed flashes in Spain and Germany, which basically led to overall eurozone flashes for headline coming in at 1.5 versus 1.8. This again is trending down from the 2% previously. We had core coming in at 70 basis points. This again is trending down from the 90 basis points previously and the 80 basis points that was kind of expected. And again, this has very strong and important implications to eurozone rates, as well as the dove hawk skew within kind of obviously the ECB, and it's one of these things that I think is very kind of contested right now in the market, i.e., how much of the inflation is real and sustainable, and how much of it is just primarily from low base effects in oil. So that's definitely something to do quite a bit of thinking on. Moving on to obviously the COT report. You can see here it's massive liquidation in U.S. dollar net longs. Just shy of 14 billion. We were up close to 19 billion from 2 Tuesdays back. So that's close to a third off. Interesting to see kind of two extreme positions. The Kiwi one we already had from last week, but a new one here on the Loonie, right? Obviously, post that kind of oil liquidation that we had kind of 2 weeks back. And then we've also had really, really big reduction in yen shorts. Interesting to kind of see that. If you recall, we got to about 110.11 last week. The Mexican peso is now into long territories, which is something we've been talking about for quite a few weeks, and that's kind of playing out. Interesting to see again that the Euronet short, basically touched its third week of buying, and we're now at 9-month lows. And despite all of this, Aussie longs continue, right? There was another 16% increase in net long on Aussies, and if this trend kind of continues, we could see actually new one here longs from a kind of a positioning kind of perspective. Moving on to the commodity side, again, combination of net shorts continuing grains. This is, I think, now going on maybe even 2-3 weeks. We did see some traction in the metals, predominantly in the likes of gold, plus 50% in improvement in net long positioning, silver as well, a quarter, and again, very, very good kind of price action and performance, particularly in silver last week, which really actually smashed it up. And also just interesting to see that despite the kind of bottoming out and big move back up in WTI back over 50, as we were talking about, you actually saw a reduction in WTI crude NYMEX. So interesting to see how this is going to basically change over kind of next week. And just kind of flagging that, in addition to kind of the extremes we had last week, they've continued, and then we have live cattle kind of joining 1 year kind of extreme kind of positioning, in this case on the long side, and joining kind of the feeder kind of cattle space. Moving on to week ahead. Basically, I think this week is going to be very focused on a combination of obviously FOMC minutes. We also have ECB minutes, which I didn't put out here, but actually could be a little bit more interesting. We do have obviously being the first week of the month and the quarter, we will have final PMIs and growth numbers. Importantly, will be U.S. ISM and PMIs, obviously non-farm on Friday, but more average hourly. And then there's obviously a lot of press play on the actual first meeting between Trump and Xi. Big cover of the FT this morning, where there's an exclusive kind of Trump interview, and again, kind of classic kind of posturing, basically saying that if they don't, if China doesn't join the U.S. in dealing with North Korea, then the U.S. will deal with North Korea. So, kind of classic kind of controversy stuff. I think it's going to be another one of these things where there'll be a lot of fanfare around it, with probably very little kind of coming out of it. But again, very much interesting kind of to watch, and of course, very key that they get to meet for the first time. There's two main central bank rate decisions, both of which the market is currently expecting no kind of decision one way or another. I don't really have a strong view. There's a few Fed speakers, and we already had kind of daylight saving shifts over the weekend for both Australia and New Zealand. Worth noting, China is back in on Wednesday, and we will also have RBA's Lowe speaking tomorrow, Olsen speaking tomorrow and on Thursday, and of course Paulo's over on Friday. So these are kind of the main kind of economic data which we kind of already covered. I think just from a perspective of positioning and where do we go to from now, it's still a question of market kind of looking for what the next kind of key focus in. Obviously, from a geopolitical perspective, Trump and Xi will dominate headlines this week, probably taking a little bit of thunder away from the Article kind of 50 and what's going on in the European Union. But, apart from kind of FOMC minutes and U.S. non-farm payrolls, I think it's really going to be, French elections that are going to start to gain more and more focus over the next 2 weeks, even though it seems to be pretty kind of consensus with the market that this is a slam dunk for Macron. I was a bit kind of very surprised with the watching of the Fed speak last week, because from my perspective, it's really June 14th, which is the next meeting. I think May 3rd is a watch. That's just a press kind of conference situation. So maybe what could be more important could be the ECB meeting again on April kind of 27th. Again, depending on how inflation plays out over the next kind of month, seeing whether that's more hawkish pressure or dovish delight for Draghi, who, to his credit, has said quite a few times that's why he's been watching the core, because he's been worried about just potential effects from energy prices, how much is structural, how much is real. And I think I'm not really kind of buying the U.S. dollar bounce, even though looking at the charts, and I'm sure JK will give us an overview very shortly. DXY was still looking very strong and looking like it kind of had a little bit more upside to go from that perspective, and the euro is actually looking very horrendous from a chart perspective. It'll be interesting to see what JK has to add on touching on those. Tactically, I still like oil. Still think we get into kind of easily 51, 52, maybe 53 to the top side on NYMEX, WTI. Still like the precious metals. Price action has been spectacular in silver. I think I was very early on the euro bullishness. And we kind of got to get clear up on what the inflation picture really is. Is this a consolidation and temporary pullback, or is this something structural where we actually have seen the highs in CPIs That could have quite big implications on both Eurozone kind of rates, ECB kind of policy, as well as kind of inflation expectations, right? I don't really think we have is my gut kind of feel right now, given China PPI, global growth kind of robustly, but it doesn't mean that we're not maybe set to just consolidate and pull back a bit. Quick kind of take on the portfolios on the strategic port. No new positions. I did adjust the BRL short that we put on, so wider stop loss and just adjusted it to a wider profit target, which I think is more akin to a strategic book, right? A strategic book, in my mind, should not have tight stop losses if you're waiting for that trade to kind of play out over 3 months to 24 months. We are watching ZAR, where, as you know, Andrew Bresla is our resident Springbok. He is flagging that there continues to be way a lot more press, very negative on Zuma and the new, obviously, implications of forcing the finance minister kind of out. We think that there's potentially a lot more kind of downside on dollar ZAR. I mean, it is tighter than where we were on Friday. We're in kind of now around these 13.37, but we feel that 13.75 to 14 is very doable. And in regards to people looking to potentially buy, maybe you want to be waiting for us to kind of get into the 14.5 to 15 angle. But I think net, what we're trying to say is there's more to come. Expect protests, expect a lot more kind of ripples to play through on this. In regards to the tactical book, there's a few things. Again, no new positions, but we did get stopped out of the short DAX, worked beautifully on Monday, and then got taken out pretty soon after that. And we hit the first profit targets on both long WTI and long silver. In hindsight, to be honest, especially on WTI, it was actually the most conviction. If you go back and you replay last week's call, you can kind of hear it in my voice. But the positioning was actually quite small. But that's also kind of part of the process. Our Eurodollar longs are still underwater, but the stop is still pretty wide for now. It's about a figure, so we'll have to wait and see how that goes. And again, the back of my mind, I'm maybe thinking about kind of shorting bunds, having a little bit of look on a few kind of other commodities, but I will send out mail if there's any kind of new trade updates. And with that, let me please pass it over to JK. Thank you.
Thank you, Kay. So starting off with the dollar index, and just when the market thought that the US dollar was dead, and as it looked like it was being carried out on stretches, the US dollar bounced hard last week after finding support at the 2016 support trendline, which I've been working with all throughout last year and presented on this weekly call for some time. The 200 daily moving average obviously also played a significant role in defending further losses. Immediate attention today is on this red trend line, which I've marked. If we stretch the chart back, you can see the important level this horizontal trend line offers, given the 2015 rejections on 2 occasions. So first level of resistance to claim is 100.5. Above here we mark 101 handle for levels to watch for opposing gains. The reversal in the euro was caught at the 109 handle and the 200 daily moving average, and the failure for the euro to settle above here against the backdrop of the US dollar index finding support above its 200 DMA was a giveaway that perhaps it was time for the euro to commence a retracement. We look for opportunities to turn positive. Our attention this week is on the January-March trend line. So starting at 105.90 we mark support. We can't rule out a false break of this trend line, so 105.70 is also a favored level to line up some bids. Stops to be placed below the February-March swing low here. So sell stop if offered at 104.90 would be the trade setup. The retracement should technically terminate here on the trend line, and a rally should initiate aggressive gains. This will reinforce another challenge for the euro towards the 109 handle. The Euro-Aussie last week found itself failing its gains at the 61.8% retracement between the December 2016 swing high to the February lows. We look for a tactical bounce this week. We favor these noisy levels here, which coincide with a 61.8% retracement between the February low to last week's high. So the trade setup would be to start building long positions here at the 139 handle down to 138.85. Sell stops on all long positions to be placed if offered at 138.60, which is below this swing low here. Now, should our levels hold, we target the 141 handle to take profits. Despite the broad-based US dollar strength which was seen in the dollar index, we also saw the Swissy close at its highs, the euro close on its knees. If we turn our focus to the finish seen in the dollar yen, Friday's reversal is peculiar and perhaps signals that the dollar strength included with the rally in risk assets could prove to be short-lived. Starting off with the weekly chart for the dollar yen, we saw the dollar yen kiss and react with immediate force of the 200 weekly moving average. Over to the daily chart, it failed to push beyond 38.2% retracement between the March highs to the lows here, which gives reasons for caution in the USD strength story. The market want to see a push above here at 112.16 this week, which we mark as resistance. A failure again to settle above here for the week could initiate losses towards the 110 handle. In addition to the dollar yen, another pair I'd like to cover this week is the Aussie yen, which acts as a pretty good gauge of risk appetite. And in what looked like to be a strong finish last week, the pair suffered losses off its intraday highs as a result of the yen's strength. On another tempting gains, should we get one, we see an opportunity to sell at 85.90, which is a halfway retracement between the 2017 highs to the recent lows. Failure here sets the pair to send a strong signal across the board that we may be entering a period of defense across risk assets. Talking about risk assets, if we compare the Aussie yen to copper and do a price overlay, you can see the close correlation between the two instruments. And I highlight the underperformance in the price of the Aussie yen compared to copper, which raises the question whether this pair is front-running moves to be seen in copper, which should then lead to moves to follow in equities. Over to equities, this is a chart of the SPY futures. You can see the technical pause being offered at the upper channel trend line, and this trend line is the test to break in order for higher moves to follow. 6,000 for our spot index is the target to claim, where we would see a great sell setup. More on this in the coming weeks. Our last day of the day goes to the S&P 500. I mentioned the significance of the recent 2017 top that came in several weeks back on this weekly call. And since then, we have been seeing already one set of a lower swing high. And should Friday's high, this swing low, hold, this sets up that third lower swing high, which obviously would be taken as a bit of a bearish confirmation. And will set up the index for further falls. Firstly, to test the March 2017 lows here, and a breach of this level would open up 2,300, these levels here. That's pretty much it for the charts for the week ahead. Kay, back over to you.
Fantastic. Thanks so much, JK. And again, thank you everyone for your time today. Do check out the replay when we send it out. And of course, please do join us next week and spread the word. And wishing everyone a fantastic start to the second quarter. Thank you so much.